Well, hopefully everyone's enjoying their summer. It's been a minute since we've been here with you. We're excited to be back, and hopefully you're excited to see us or hear us again. You've missed our lovely faces and voices, but
How
this
about
is your closing bell. How you been, Mark?
how have I been? I'm excited to be doing this call right now. I mean, I think it's been a while, about 4 weeks, I think, since we've been on. So excited to share some news and both about our business and also about some personal news of what's been going on. So yeah,
Absolutely.
good to see you, Jay. You going? How you doing? Right?
Yeah, hanging in there. And I think that's the
Yeah.
beauty of this is to be able to communicate with the masses, both clients, friends, family, prospects, industry professionals, and colleagues, right? Where we can kind
Yeah.
of be real of what's going on, not only in the economy and the markets, but also personally, because that's what this is about. This is honoring the real. We're not trying to be fake. And we'll dive into that in a minute. But before we do, why don't you share the exciting news with what
Yeah.
what you've been dealing with the last month or two?
So I think the last time we were on here, we shared that, hey, we got some exciting news coming, and blah blah. And I actually got some people that reached out and said, "So what's the exciting news?" Because I haven't heard from you for weeks.
Yep.
And I had to tell them, man, it's on hold right now because of just things that have happened. But let me try to explain. And again, thanks for everybody for listening in. So about 6 weeks ago, very exciting. Our business has really grown a lot, especially in the last couple of years here, and it's been really exciting. And thank you to all our clients and just yeah, I think through our marketing and different things, it's just we're getting the word out about Boyer Financial and kind of our niche, our family atmosphere, and so we've grown. We're getting lots of great referrals and so forth. So all good, and so we're super pumped about that. And because of that, we've gotten to a place with assets under management to where you and I talked about a while back. And I'll say this to those folks listening, Jason.
Sure.
Jason's always pushing the envelope with me, man. I'm like always kind of like a little more conservative, stepping back, just kind of like, hey, let's slow this down. And Jay's just like, let's go, Dad, let's go.
Yep.
We could build this thing and keep going. So we're yeah. So that said, so we decided because of where we were gonna request from the SEC, Securities Exchange Commission, to become our own RIA. So what that means is registered investment advisor. In a nutshell, it's very exciting for our business, for our clients. We've been with LPL and for 22 years, and under LPL, we've always been independent, which means we don't have any proprietary products to push. We always try to get on the side of the client so that we can sit down with them and see what they have and try to build a game plan for them to really benefit them and their family and so forth. And so we've had that independence, but we've been under a corporate RIA with LPL. And so basically when we petitioned the SEC about 6 weeks ago, about 4 weeks ago, we actually finally got the news right in that time period. We got the news that we had been approved. And so we are now officially approved to be our own registered investment advisor. And so that just opens up, just so many opportunities for us as a business. I mean, the benefits of RIA is like just max independence, not only for us, to hold money in different places, custodials, where we put money right now, we do everything at LPL. And as of now, that's where we still are and may continue to be. But, it gives you options for if you get clients that have money at Schwab and different places, Fidelity, you can actually have custodians in different places and so forth. And, so complete lots of flexibility. There's, the technology, which you're all into. We've already started going down a path of building some incredible technology for
Right.
apps and just online experiences for our clients so that they can see their whole picture. Lots of great stuff, right? So
Yeah.
all that said is that all happened and we got that approval 4 weeks ago, and so we're so pumped about what that means for us and our clients. So very exciting. And basically, in a nutshell, we have like 120 days from that period of time to really make some decisions and kind of move in that direction. And so what does that mean for our clients who are listening today? It means at some point here, and we're going to be, I've talked to a number of you already, but we're going to be, eventually we're just going to, whether, if we stay at LPO or whatever, there may be some paperwork that we'll have to get, DocuSigns, different things just to transfer your accounts. Like right now with LPO, we're at SAM. If we, in the RIA space, it becomes a swim account, which is a different account. We just got to get, we have to get their client's approval to move things over. So all said, you're going to be really thrilled as clients of ours to see what's coming.
Yeah.
And the only thing really is going to be is we're just going to have to do some paperwork. And I despise paperwork. I despise all of it. But we are committed to making it as seamless as possible for our clients. So I think about sometimes people like, oh, I don't like the change. Are you changing things? Are you going to be less family or all these things? The answer is no. Yep. We're just on the back end in the behind the back office area. We're just becoming much better and just so many more options for both our clients and for us in all that space, right? So it's very exciting, and we're pumped. And that's why we were so pumped at the time, because we hadn't quite, the last time we were on this, we hadn't quite gotten for sure that we were good with the SEC, but we felt pretty confident we were. So bottom line is, this is like a 4-week ago announcement, but we've been approved and we're moving in that direction. So we're super pumped, right? It's exciting. And so if you're a client of ours, be expecting, us to be in touch. We'll be answering questions. We'll always be Boyer Financial and, in that family atmosphere and all that. We're just going to have more options behind the scenes. So we're excited about that. Right?
Yeah.
That's where we were. That's where we were last time. We just didn't, like I said, we didn't have the official announcement. We couldn't tell you because we hadn't been approved. So that happened right after our last call.
And so the cat is out of the bag. We are officially approved as an RIA with the SEC, which is the Securities Exchange Commission. So we don't have to register with the states, which is nice. You notice file, but you register nationally, basically, which is a little bit easier and more streamlined, different governing bodies, so on and so forth. But to our clients, like you were saying, so what the heck does that mean? Is like, what kind of, am I still going to have account view or what's happening there? So like you were saying, though, the tech stack and the ability to utilize maybe some things that we hadn't been able to before with reporting data, research, risk tolerance metrics to kind of making all, putting all your financial lives into one program where you can see everything, your bank accounts, to your risk scores, to your financial plan, to your investments, returns, 1, 3, 5, 10-year inceptions, and way more into the weeds than that. I'm just making it as basic as possible, but we'll have our own app, Boyer Financial Services app on the App Store. You'll be able to download. You'll have a portal where you can log in where, again, everything, your whole financial lives are going to live. It's going to be awesome. It's going to be intuitive. It's going to be client friendly, and it's going to be top of its class in terms of technology. So we're really excited about that, delivering that to our clients. Again, delivering that kind of 5-star experience that you've come to expect from talking with us. And now that technology piece is really going to catch up and kind of boost our total offerings there. So anything to add on that?
No, no, you hit it all. And there's even more. Again, we're going to be in touch with you. We'll be talking. We've got some decisions to make still. So pray for us there, make some good decisions. Again, the whole idea being that, everything we do, we want to be enhancing it's for our clients, and for their good. So, if you've got investments now, we've got certain things, you're not looking to sell anything, we can carry all those things into this new RIA. So there's not going to be any changes there. The only, and sometimes people are like, I don't like change. Well, you know what? We've all been through times where you didn't want to change something, but I'm sure every person listening has a situation where it's like you kind of fought a change, and yet once you made that change, it was unbelievable. And you're like, why did I wait so long to do it? And that's kind of like where that's what this is going to be all about. It's going to be, you're going to be on the other end of this, even though you got to switch, sign something just to switch to a different type of an account. With the custodian, it's going to be seamless and super, super good on the other end. So, So anyway, any questions on that? If you guys do, as we move forward, just make sure communication is key and we'll be communicating well with you as we move along.
Yeah, absolutely. So that's exciting news. And another personal news, we had some not exciting news, which is also why we kind of have taken a little hiatus to
We went
spend some
dark.
time with family. Went a little dark, and if you've read some newsletters or followed us on social media, we have announced it. And I'll try not to cry on camera here, but I'll keep it as brief as possible. But my youngest was diagnosed with leukemia about 6 weeks ago or so now. And
Right at 4 or 5 weeks ago. Yeah.
yeah, my youngest Luca. So just be praying for him, please. We just finished the first month of treatment, and about 90 to 95% of kids after the first month go into remission with this type of ALL leukemia. He was not one of those, unfortunately. There's still 17% blast cells or whatever in his bone marrow, which is pretty high. So, I think he's just going to need a little special cocktail of vitamins or, chemo, whatever it may be to get him over the line there. They're still optimistic, and now is not the time to panic or anything like that. But just wanted to let you know that specific number 17, we need it at 0. And then once we get it to 0, we have access to some incredible new drugs that were approved as of last week. And he will be getting that. So we just ask all of you out there to pray for him, pray for us. And we know he's going to pull through, but it's definitely scary. It's definitely a vulnerable place to be, but we have a big God and ultimate healer, and that's, as a dad, Mark, I'm sure you can relate to this, is you want to fix things in your family. You want to be the one to be able to be there and be the strength and the not only the family provider here on earth, but also just fixing your kids' problems or being the ear. And this isn't something that I can fix, and it's breaking my heart. So we'll be okay. Just keep us in your prayers, and that's all I'll say about that now. But we'll provide updates every week and help have you guys walk along this journey with us. So
Yeah, Jay, thanks for sharing. Yeah, and I'm gonna cry too. So it's been a tough time, but I'm thankful for all of you who have reached out and heard about it, and we're praying for Luca.
Mhm.
We're it's good.
Yep.
Sorry.
No.
Again, we're family here, right? It's just tough, and you've done a great job leading. Jay, just your family, Melissa, and we all wanted a different kind of, we wanted a different result yesterday when we found out that he still has it. But cool thing is, my quiet time with the Lord, I know it's still God's got him, and
Mm-hmm.
so he'll be good, and we're gonna get through this. I told Melissa, because she's ex tennis player. It's like, hey, we thought maybe that first month of this, we're gonna three sets and we're done. But this has become a 5-set match in the near term. So we got to grind. We're gonna have to win it in the next couple months here. So anyway, thanks, dude. Thanks. You've done a great job, and you guys have been amazing. And I appreciate everybody again who's on this podcast, who's prayed and continue to support. Just it means a ton to the family. So we'll get through it. Trust in the Lord. He's got us, and he's got Luca. And I just love that little boy. So it's just he's an angel.
He is, and he's full Luca right now. He's wrestling me this morning and punching me in the face and all that good stuff. So he's a fighter. He's before he was honestly like Mr. Silent manipulator, kind of the baby of the family, just kind of if his brother touched him, he'd be like, and he'd cry. But now he's like wrestling
Let's
and
go, baby. He's
hit
a
people in
fighter.
the face, and now he's turned into quite a big fighter, which he's
He's a
going to
fighter.
need, and he is, and it's going to benefit him in the long term as he grows up too. So
he's a fighter. And Jackson, 2 years older, is 4. He's doing well. And then just as a reminder, Melissa's actually pregnant. You guys are going to have another little boy here in September. So a lot going on, man. So anyway, it's Luca's going to be good. And I just know God's got big plans for him. So He's doing a good job.
Yes, so let's talk a little bit about a new reality of investing. That we're already 15 minutes in here, but just so you know, we're going to talk a little bit about an outlook for the rest of the year, what we're looking at, what we're expecting. Want to read you a little something I came across because I think it's really important, and then we'll kind of dive into some inflation targets, where we're at, where we've been, where we think we're going, macroeconomics. So look across the world real quick, and then we'll kind of bring it back to the U.S. and with the boring bonds, as we like to say, but not so boring right now, right, Mark?
Yeah.
So, all right, so let's dive in. So, over the past 40 years, everyone, longer than I've been alive, longer than Mark's been alive,
Easy,
too.
easy.
You're young. You're 41 now, right? 41.
Yeah.
We've been accustomed to an environment of what? Declining interest rates, right? Low interest rates, low inflation, and a really big advance in globalization, right? Global supply chains, China, India's come out, the United States, South America, Europe, even some big players out there as well. So there's been a big globalization of businesses, multinational businesses, and so on and so forth. So it's been relatively stable. Now, all that's changing, and I'm sure everyone's aware of it. Interest rates in the U.S. stand at a 23-year high still. Its inflation is falling, but it is stalling as well, and it remains uncomfortably elevated. I'm sure you go to the gas pump, especially here in California, or you go to the grocery store. Even home prices, even though they've come down a little bit, are still elevated. So, you're seeing still high sticker tags, price tags. We're seeing signs, though, of deglobalization, right? We're deglobalizing that supply chain. You have factories that are companies that had factories in China or, Southeast Asia, have kind of moved them back to Mexico or the United States to help kind of, COVID proof their business models. Because remember, COVID supplies were hard to come by for a lot of big companies and corporations, from electronics to microchips to cars, so on and so forth. And then we've seen, rising tariffs, growing trade wars, relationship between U.S. and China has kind of gone cold, ongoing conflicts, Middle East, Ukraine, Russia. So what we want to talk about, though, is where we're going, where we're moving. What is 2024 going to look like for the remainder of the year, or so what we think, right? Bonds, source of superior returns potentially. If you're holding intermediate core plus bonds, high quality bonds could be a good place to be. I think we're going to see a less dense group of highly valued companies dominating return, aka the Mag 7. I think we're going to see that start to broaden out a little bit. And then even in a more pessimistic environment where you've got so many moving parts and things changing, I think it's going to present an opportunity for some individual stock selection will make a profound difference. So whether it's, important, we talk about active management, right, Mark? We talk about having, whether it's ETF or fund managers that are really selective and picking specific companies that they believe are going to have near and long-term growth prospects, which is ultimately going to drive the share price higher, or even individual stock selections and portfolios that we manage as well. So let's dive in a little bit. Any initial thoughts? I mean, we've had a little bit of a pullback this week. Anything that you're kind of looking at before we dive into the inflation piece?
Yeah, and I think it's good. Again, sometimes talking about, I was just here talking to Luca. Sometimes life, it's like, what does what does the money even matter? It's our families and so forth. But again, it's we've all been given assets to we're stewards of, that we need to do our best to manage them well. So great oversight in regards to what you just shared. I think that I think we've seen here in the recent days, actually, we're kind of going into a tough time, which is not unexpected. We've been talking about that for a while in regards to the markets. In over the last week or so, we've seen a real pullback in the tech stocks. Especially the Mag 7 that have been leading the way. They just, frankly, just got, overdone. I mean, and seen this before, and we've talked about this before, that sometimes pullbacks are actually healthy. And so we see this as a healthy pullbacks in the growth names, the big growth names. and also in the same period of time, we've actually seen a transition going on. We're seeing a broadening out of some leadership. We see money going into the dividend paying stocks, which we've already had positioned a lot of our clients in. Um, I was encouraged to see one of our largest, active money manager in a growth kind of growth oriented portfolio that was already over the last 3-4 months or whatever been really pulling back some of those growth names, because again, that's why you want active management that's doing the research, and they're in there day and night. They're talking to these companies,
Yep.
and they still like the companies, but they're just realizing, we got to take some off the table. And so, when you do that, you might lose some of the upside at the end, but then you don't get hit as bad when, there's just there's other opportunities. So like you talked about, the transitioning to some dividend paying stocks has been a really good move. We're seeing that globally. The dollar's been strong, and yes, Japan, India, which we're going to talk a little bit about here coming
Right.
up. Those are possibly good areas, but the dollar's been stronger, which causes that to be an issue. Bonds, boring bonds, they're out there. We'll talk about that, but there's just, again, all that to say is, I'm just going to encapsulate right now is that balanced portfolio is super, super important. The real move in there also has been the small caps. For the first
Yeah.
time in a long time, small caps, there's been a real rotation back into small caps, the Russell 2000, and some of, our small cap, allocations and portfolios have really benefited in this place. So,
Yep.
again, we like to see that broadening out, because that just means more people are getting involved, and that's kind of how we've been positioned ourselves going forward. So some of that's, some of that is working out for us right now. So yeah, a lot of good things happening. You got the elections coming up. What does that mean? We get a lot of questions like that too. So we could cover a few more of those things if you want to on the
Absolutely.
call. Yeah.
Yeah. Good points. And I think, wading through all this, we need to look at the Fed, and their rate path, and how it's probably going to mirror, inflation's slower descent. They've been slow to act on it. They've kind of been in a wait and see posture.
Yeah.
Markets are pricing in, I believe it's about 50-50 last time I checked, of a September rate cut. The latest inflation's come in. It's about 3% or so. We're hovering right around the 3. So we're slowly making our way down. Again, 3% inflation's, it's very manageable. Economy can thrive in a 3% interest rate environment. So it'll be interesting to see
Really? You
what
think
the
so?
Fed.
How do you know? You've never seen that before. You
I
young
know,
people,
right?
you've never seen it. Yeah,
I
I agree.
I do my research, and
All right.
from what I saw, no,
Way back when
but
when I was age.
yeah, yeah, your house, right? 13% mortgage rate or whatever it was initially. But all this to say, I think it's really interesting to look back. I mean, we kind of forget where we were at some point. For us, our peak inflation, June 2022, 9.1%. Eurozone, 10.6%, October 2022.
Mm,
And then the United Kingdom specifically, remember Brexit,
yeah.
11.1%. And
Mm,
Japan, 4.3. Now, all of those countries are below where we're at. So Europe, Eurozone, United Kingdom were higher, over a percentage point or two higher than us, are now a percentage point lower than us, basically, last time the data came out. So it's quite interesting to look at. Are you thinking potentially rate cut September? Or are we going to wait and see post-election, maybe 1 year end?
yeah, I mean, recently here, the numbers that are coming out, I mean, I don't know. It looks like, it's interesting. Two of the Fed officials that, are that are on the decision-making process of lowering rates, came out and basically said, man, we got to lower rates now. I mean, they're seeing some numbers. There was only two of them, but there was,
Yeah.
they came out and basically that's kind of the concern at the moment, because there's some underlying numbers that look like this economy is slowing down faster than that the frontline numbers sort of indicate. Again, if you're looking at unemployment, things like that, those are all lagging indicators. Some of the other ones now are looking. So anyway, yeah, I think we're going to get a rate cut probably here fairly soon. September is probably going to be the case, and then I think the market's expecting another rate cut, by the end of the year possibly. So we'll see. I mean, they got room to move lower. You hope they don't wait too long. Um, and all that is good for fixed income, right? When we've been talking
Yep.
about that for a while, but
Mhm.
finally, if we get some rate cuts, that could be really beneficial. I think that yeah. So again, the numbers are, like, well, you gave some really high numbers of inflation. And I know some areas, it's hard. Sometimes those numbers, you seem like, well, it just seems like it's higher than they're saying it is,
Yeah.
so, there's part of that, I agree with that to some degree. So I think that, but the point is that it seems to be inflation is, they're coming in lower. So that's a positive thing and what the Fed's been looking for. So, as long as we can get our fiscal house in order, and especially as the United States, we're sort of the global leader right now in growth
Mhm.
still.
Yep.
But we got to stop spending more money than we have, and that's another area that, you know, um, that's going to be really important to bring in, to rein in somewhat to, I think, for the inflation numbers to be lower here in the U.S. Longer term.
Absolutely. And yet, like you were saying, the earnings growth potential, we do see potential uptake in earnings per share growth over the next few years. You're looking out,
Hmm.
PE multiples over, longer periods, such as a 10-year period. They're a little bit lower right now. Historically kind of right on track with the S&P 500. Talking about individual companies, forward earnings um, look out.
Yeah.
But
Or
yeah, even overseas, there's some good attractive opportunities as well in the Eurozone, Japan, um, even, India. There's places again that again we have fund managers that are looking at these places and looking at potential opportunities for growth. Because again, those guys have boots in the ground. They're at these companies looking at their balance sheets, income statements, looking at products and pipeline development, R&D, leadership. It's there's just so much that goes into it that we would be doing a disservice to our clients being like, oh, we're going to go to India and,
yeah,
spend 2 weeks and travel around and look for all these great companies. It's like you don't want Michael Jordan playing baseball. We saw what happened when he did, right? So let's stick to what we're good at
great
and,
example.
and
Yeah,
utilize people that are actually professionals in those specific areas. And, and that's all I have to say about that.
yeah,
But I
yeah.
thought
That's how you sometimes. Yeah.
but let's talk elections. So since our last closing bell, some big news has come out. Obviously, one, there was an assassination attempt on President Trump, which is insane. We haven't
Unbelievable.
seen that since Reagan. And then also, President Biden, finally has stepped out of the race after like literally that morning. They're like, oh no, he's his spokesman. We're gonna continue running. Everything's gonna move forward as planned. And then he pulls out that same day. So it's gonna be very interesting to see. Um, and this is all kind of new news here in terms of supposedly Vice President Harris is now the front runner to be the nominee on that side of the aisle, and obviously she has a lot more uh, different ideas than maybe a kind of center aisle Democrat, a JFK Democrat or
Are you
somebody
saying
like that.
she's very left leaning? Is
Yes,
that, yeah, okay. All right.
yes,
It's fair.
yes. That um, don't what do they say? Don't CA our USA in terms of politics. So yeah, we're gonna stick with that. That just describes it, and she's from that. So um, anyway, I'm gonna be a little bit more brash on that, just because what's important in life. I want again, you can have differences in opinions, but let's all move towards growth and prosperity and
Freedom
equality,
and
yeah, and freedom, and yes,
true
exactly. So
freedom.
exactly. So let's talk about potential beneficiaries of red and blue waves. Let's talk about some maybe sectors. Maybe you could touch on the red wave side of things real quick.
Yeah. So, so politics, right? You're gonna can't get me started, bro. I'll roll on this one for a while. And, but yeah, I think that's the main point as far as looking at elections. I think what we want to share today is that, basically, historically, if you look at, the elections, frankly, in the stock market, there's really like, I think, there's a mute difference as far as performance of like the S&P 500. Whether which party's in power. I will say that the markets as a whole typically like balance of power. So they want some they usually do better when there's like
Right. Checks and
whether it's
balances.
a Republican president. Yeah, there's checks and balances, and there's some type there's a Democratic Senate or House. You know what I mean? So just some balance. They like it usually better that way overall. Yeah, these are big elections, but what's interesting is like if as far as a Trump win, potential beneficiaries, is really when you're looking at investments. There's certain industries that might benefit from a particular party that's in charge. For example, potential beneficiaries of a red wave would be like banks and financials, because they're about weaker regulation, lower capital requirements for banks. There's another place is aerospace defense, proposed increase in spending with Republicans in charge. Healthcare, proposed deregulation, promotes competition, efficiency. That can help profits, and then really finally we hear Trump talking about it, and I've said it over. I think this is a big part of why we have a lot of inflation still today,
Yeah.
is we stopped oil and gas
Hmm.
production the day one that Biden got into office, and that just affects every industry because it increased the price of fuel and
Yep.
across the board, and a red wave, or if Trump wins and comes into power. I mean, he's talking about drill baby drill like day one. So that domestic drilling and mining will be encouraged because of the deregulation, and so that could result in lower price per barrel. So
Hmm.
anyway, that would be a benefit there. You want me to cover the blue side, or you got that?
Yeah, go for it.
All right. So yeah, and then if Democrats win or they have a blue wave, there's going to be obviously you'll see renewable energy, electric, the whole thing on the electric vehicles, which has sort of been kind of slumping because a lot of that's played out already. And in my opinion, just people that wanted those kind of cars, which are great. I mean, they're fantastic technology for the
Hmm.
most part, but you're probably and if they continue to control, that'll be still a big piece.
Yeah.
Those places will be benefactors of that. Telecommunications is another area. Expansion of broadband funding, home builders and industrials, increased immigration. As immigration continues, that should keep wage inflation low. That affects a lot of other areas, but you got continued immigration coming in. The
Cheaper
price
for
of
the home builders to hire cheaper
yeah,
labor.
yeah.
Basically,
I
that's
mean,
what
those
that
are
means.
those are benefits. It's figured, if you're about making money and you can pay less,
Yeah.
you're gonna pay, others that will work for less.
Yeah.
You'll bring more of them on. Continued, and then finally tech kind of manufacturing. There's a tech side that continued stimulus support through the Chips Act and the like. So anyway, those are areas that can really benefit also from Democrats winning. So as far as that goes, there's a lot of bigger issues this year, but as far as industry wise, those are some areas that can benefit in either direction, whoever's in charge.
Good points. Good points there. So kind of depending on what you personally as an investor or political activist or whatever it may be, what you believe in, those are specific areas that maybe that you feel strongly about, such as the Inflation Reduction Act or CHIPS Act, or you know, um, home builders, profits for home builders and hiring lower wage workers, that are basically displacing other legal low income families such as Hispanic and African American populations. But whole different conversation there. But one thing that you kind of mentioned earlier, talk about stock markets. Since 1950, we've actually had 1,434 new all-time highs, 1,434 all-time highs since 1950. Now, when the S&P has reached a new high, its first new high in more than a year, the positive returns that next year, 13 out of 14 periods, and the average return, 17.1%. So We hit an all-time high this year. We've had a little pullback here as of late, but over the next year, the S&P, if you're looking at this historical information, which is from Capital Group, Rhymes, and Standard and Poor's, dating all the way up to May 31st, 2024 is when the data stopped. 17.1% average year-over-year return for that following year of hitting that new high. So it's very interesting to see if that's going to continue to play out this next year, considering geopolitical uncertainty, elections, and economy, what's going to happen, so on and so forth. So, yeah.
Yeah. So what does that mean? That's really interesting. That's a great. I mean, you and I looked at that and we were reading about that. It's really interesting. So what that means is that, like on the S&P 500. So back on, 1231. So I'll just 1231 of 21, we hit an S&P high of 4818 was the high, and then it pulled back the next few years. And then this year, on or about, just looking at a chart here, February of this year, we hit a high and we broke through that. And so now we're at 53.99. And we've seen that. We talked about this before, because when we broke those highs, everybody's like, oh, we're at high. We got to, sell, get out. It's going to go back down. But the reality is, just to what you just said, is that the tendency is over time to keep going. So if the 17%-ish, increase is there, that gives us an S&P 500 of 5,600 and 5637. So, and we're at, we've pulled back a little bit. We're at 5,400. So anyway, I guess just on using the averages, that gives us we're still, a couple hundred points on the S&P below that 17. So that, all that to say is that would be the averages over time. It's interesting. Once you break, it's really interesting in markets, is that when you break these highs, the momentum is always to the upside, and usually it starts feeding on itself. So that's why I think, for us, we continue to be fairly bullish, on the market, just based on those facts that you just mentioned there. So anyway, sorry, I'm giving you the actual numbers, but that's really interesting to me. That's, and we've seen it. We're getting a pullback right now, especially in the high tech ones, but that's probably needed. And again, that's healthy. And especially if it broadens out, that could be really positive going forward.
100%. Good points. So let's talk. AI has kind of dominated the conversation this year. The Mag 7 AI, where is it going to go? Has it kind of overshot its landing strip, its runway? Well, let's talk about AI and like what that means. Everyone just thinks chips, Chat GPT, software applications. Well, let's just look at like where the opportunity is at this point. Well, in order to understand where opportunity is, I think it's important to understand that the AI stack consists of 4 different layers. So let's break those down real quick. Let's start with semiconductors, the bottom kind of rung of the stack. Semiconductors, think about companies like NVIDIA, Broadcom, Taiwan Semiconductors, and ASML. Those are kind of your 4 big players jockeying for market share. But it's actually interesting. So there's different, even in semiconductors, you get chip foundries, you get different parts of these chips that different companies might make, which would be more integral in a chip being made, or might be more necessary or needed in specific types of graphics processors or AI learning, whatever it is. And again, I'm not a tech guy to know all the individual parts, but like, for example, Taiwan Semi actually provides the chips to NVIDIA, and then NVIDIA provides them to Microsoft and Sony, Samsung, and car makers, and all so on and so forth. So again, these aren't linear, like they all do the same exact thing, but let's just break down the different sectors of the stack. So again, semiconductors, NVIDIA, Broadcom, Taiwan Semi, and ASML, 4 big players. We level up 1 to infrastructure. That would be like Microsoft and Amazon and Arista Networks, data centers, places like that where your information will be housed. And then also kind of what's interesting is you're going to get the energy piece. So, some themes to look at for the rest of the year, along with AI, would be data centers and energy, nuclear energy, renewable energy, oil and gas, things of that nature, all used for similar things and also very different things as well. For example, Constellation Energy, company I'd been looking at for a while now, actually struck a deal with Microsoft to supply one of its data centers with nuclear power. So therefore, Microsoft wins, Constellation Energy won, and that boosted their profits, which drove their share price to the roof. It's really interesting. So again, it's not like AI can benefit a lot of different things as well. Then let's go up to models, like AI models. So like now that's like your Chat GPT, things of that nature. OpenAI, which is Microsoft, and Alphabet, which is Google. And then on our top level, our software applications, which would be like your Meta, your Adobe, Microsoft again, and Salesforce. Very different, maybe utilizations in the business and recreational fields, but all kind of jockeying for position and market share in their respective industry. So that's just a quick breakdown of AI, but still some great opportunities. You're getting some pullbacks in your Googles, NVIDIAs, super micros, companies like that, but still some good opportunities, even because they started paying dividends, which is something that I think is
huge.
to look at. Your dividends are huge. It means they got some great free cash flow to pass back to investors.
Yeah, that's very true. So what cracks me up about what you said, man, is like, so I was reading an article recently about, again, this AI, right? And the energy needed so there's so many companies like a Constellation, these people, there's some little companies that I was reading about that, they're getting huge boost because they have the ability to kind of restart the whole nuclear energy piece, right?
Yeah.
So here we go. Like this is an area that nobody's wanted to touch. People are saying you can't do it. I've seen nuclear, here in California, there's certain places that have been sort of basically shut down because they're afraid of nuclear energy, which by the way is the cleanest like one of the cleanest sources of energy we could have. And now all of a sudden, because this is just how it works. When there's huge money involved in it, all of a sudden, like it's becoming okay to talk about this again. I don't know. I'm just saying, it's an interesting kind of makes me laugh because, now it's getting okay again to talk about nuclear energy. And we're going to see a real resurgence there. It looks like with the AI process and, it continues to build out. So yeah,
very interesting.
good stuff.
Yep. So let's end with bonds here. So boring bonds, not so boring after all. Obviously it's kind of been a little bit longer of a journey with them. We started saying, hey, you start extending duration, which is fine. It'll pay off, but just the patience is going to be required and has been required to see that. We saw yields drop. Was it last week? Pretty big. Was that last week, right?
Yep.
So that kind of has helped the bond holders. But in your opinion, if we do get some Fed rate cuts later this year because of decelerating inflation, or even if it's kind of sticking around that 3% mark, is that gonna, you think, will that be enough, because bonds are traded in the open market now, to un-invert the yield curve? Or will that start the process of the uninversion? Maybe we don't see all of 1, 3, 5, 10-year uninvert simultaneously, but I just want your thoughts on that. I think that's kind of an interesting point if we kind of get one or two this year.
I mean, so we've been talking about bonds for a long time. I feel like it's been the top, the topic of the last 12 months, and we pulling up, we saw that the market was expecting a lot of rate cuts this year. We had said that we didn't think that was going to happen. It might be a little stickier and sure enough, it's been that way. I think I would have expected, one maybe a cut this summer or something. I didn't think it'd be this long, but the fact is that it has been sticky, and it continues to be. And in fact, I think, I think I was on record as saying I thought maybe they might eventually change their target from 2 to maybe 3.
Yeah.
Again, because if you go historically over the last 80, 100 years, inflation's averaged about 4% a year, and we've done fine. But now we got this target at 2. Seems, everybody got used to that. I don't know if that's, that's another subject, but but they're not changing. They're sticking with the two and they're going forward. So yeah, I think that a couple of things. One, the fact is, yeah, it should that uninverting process should begin to play out. It's can't tell yet if it's really starting to go there with the short term rates getting to a better place. Oops, excuse me. Um, and
Jake
let me
was
just
calling you. He said stop talking
yeah,
about
PayPal, yeah, stop jacking.
that.
Yeah. So to answer your question, simply, I think that's probably accurate. We should see it start to uninvert. Um, I don't have that chart up right now. I could
I
tell,
got it
but
right here for you.
yeah. But what are you seeing there?
So it looks like as of right now, we're looking at a 5.4 yield for 3 month, 4.37 2 year, 4.12 5 year, and 10 years sitting around 4.28.
So we're still,
Still inverted.
uh, yeah, yeah. That
5 and 10 are uninverted.
yeah, that 3 month, man, that 3 month is like seriously high, and that's
Yeah.
been the benefit. It's been great
Mm-hmm.
for clients
Money
with
market.
just little cash. I mean, geez, you can get that really nice yield, 5.5, whatever. Depending on the risk tolerance in there, for basically really short term money, it's great. But like we talked about before, what you lose out then if the rates start to decrease, you won't have the same benefit as you will have, when and if the prices start coming down or the yields come down. That price appreciation will more than make up for that little bit of higher deal. So that's at that point, I think as we continue to get lower, I think that yield curve is going to, I think that short term rate is going to really start to drop, and that's what's going to happen, and that'll drop. I don't know that the other ones. I don't know that the longer term yields will rise a whole lot as much as the short term yields really going to drop like off a cliff possibly. Once it looks like the Fed has its control of that inflation piece.
Good
We'll see.
points.
Yeah, we'll
Yeah,
see. And if
absolutely. We'll
that's the
continue.
case, again, you want to be in a diversified portfolio of fixed income, everywhere from short term to that cash, getting that nice yield, but not so much that you don't have something in higher duration fixed income that really benefits, price potentially as, and, the price will really move up the higher duration you have as that begins to change. So that'll be,
And one thing I want to point out in the bond space that that might perk the ears up of our sophisticated investors or credit investors, people that might be in higher tax brackets or near the top two tax brackets.
munis. Yeah, good point.
Munis, really attractive opportunities in municipals because their yield actually might be better in a muni, which is tax-free income,
Yeah.
right? Both federally and potentially state, depending on what you buy and where you live. But that could be a really attractive opportunity, especially if you're getting a yield premium off of a treasury or corporate bond or whatever it may be at that point.
Yeah.
So something to look at, something to talk to your financial professional about, or call us. We'd be happy to discuss that with you. But something to think about in this interesting environment, especially as we kind of go into year end here and
So the
where
only, yeah, thanks. Sorry, cut you off. Yeah, that's a great point. I like munis right now. Really good. I think the only thing that could throw this into a tizzy again on the other side of the spectrum, Jay, it doesn't look like economically right now that we're going to go into a rate hiking mode. But the only
Mhm.
thing that can be an issue for us, again, and why we have to get our spending under control is if the Fed now at higher rates. Remember that the Fed, the interest on these bonds, when the U.S. government debt or the U.S. debt, okay, what is it, 33 trillion or something?
Yeah.
Remember that's people buying U.S. government bonds, right? That's how much.
Mhm.
So the government's been borrowing money from investors, and now at higher interest rate, those interest rate payments are really high. And the
Yep.
only so the concern on that end is that's why you have to have your spending under control, because if you start to default on anything in that space, if that space starts to get defaults, whether with the banking like we've seen already, or if we ever saw the the U.S. government's already been downgraded what 2 times in the last couple of years, right? And if that were to happen again because of our ridiculous spending, that could
Yeah.
cause rate hikes to actually Uh, that would be then you could see rates go higher to a
Yeah,
place where it would be not very beneficial. Why? Because if they default, if the government defaults on our bonds, then investors are going to require a higher interest rate for that risk, and so that's the other side of the spectrum. Don't see that happening. Especially if we get some fiscal order in our government.
yeah,
I'm afraid yeah. So anyway, that's a big deal there too. So just as far as looking at that investment, that is potentially a negative to bonds again if rates go back up, and I think defaulting, if that were to ever happen, would be a big problem.
absolutely. That's a good point. Again, you don't pay us or listen to us just for providing the obvious. I think it's good just to spark the question in your brain. Oh, like what's the opposite side of that point of
Yeah,
munis and good opportunity for extended duration bonds at this point. What's the flip side of that? Well, what could happen if things did start to crumble or we couldn't pay our debts back? So again, that's not out of sight, out of mind right now, but a good question to pose and to think about. So
yeah.
yeah,
And
what-
let me finish that thought, but let me just finish that thought. So that could be if the government defaults, but the other way to handle that, because where a percentage of GDP gets too high, right, and we got too much debt, the other way to help that issue is you can reduce spending, but you can also increase growth. Another increase the GDP, by lowering regulation, different things like that. If the economy were to really grow,
yeah,
grow, grow, that could be positive and offset even. So that's on the other side as far as economically the different things that can happen. So I think
or
that
raise
I think
tax.
that makes I think that makes our politics important. Who we
Yeah.
get, who we're voting for, and yeah, it's really critical. So
100%, 100%. Well, as of now, we had 6 trillion or even more actually by more recent numbers that we're sitting in cash and money market instruments, and I think you've started to see some of that, just the tip of the iceberg flow back into the market space. But even with the latest GDP reading of 2.8% for the second quarter of 2024, 2.8% was better than 1.4, which was the revised last year. Again, that could probably be revised lower in the next reading, but first read 2.8%, which, you look at 2023, 2.2, quarter one, 2.1, then 4.9, Q3, Q4 was 3.4. So had a little spike from quarter one to quarter two of this year, and we'll see where that goes. But again, you could start seeing money trickle back into the economy, to especially if rates start to come down a little bit. And again, you don't drop them exponentially unless something's broken in the economy. So it'll be interesting to see. We'll monitor it for you. But any closing remarks, Mark, before we sign off for today?
no, I mean, I think it's again just a balance. Things coming out of this talk. I think, you know, um, some questions to ask. In the portfolio is your growth allocation of your portfolio, still highly concentrated in certain areas? Are you beginning to broaden out? Do you have enough dividend paying stocks? Do you have adequate exposure to those places? Or that's another good question, something that I'm asking and we're looking at. And as I meet with new clients, I'm asking them those things. Are you on a global front? Are you taking advantage of company specific opportunities like
Mm-hmm.
in global economies and as markets to diverge? That's another thing. And then with rates, again, just what we just talked about, are you adequately diversified into different durations in your fixed income side? So yeah, some important things as far as investments. I think coming out of this, these are good questions to ask yourself as you build that balanced portfolio in your for your game plan, but making certain moderations as changes as you need to. I would say actually small caps too. I mean, they've had a big move in here already, but that possibly could be the beginning of again a longer term trend in
Mm-hmm.
small caps that we haven't seen in quite a while. So that'll be good.
Good.
Lots of
All
good
right.
things to talk about. We're going, but appreciate everybody on the call. Thanks again. I'll just say, Jay, and I know you'll close this out here, but thanks for leading well at your house and all the things you've been going through. Our prayers and thoughts and prayers are with you and Melissa, and as you
Thank you.
continue to move forward. And we're here, to support, obviously, and to continue to pray for you guys as we go through this time. So appreciate that with all our clients out there who've done that with us. So thank you for just blessing our family that way and being a part of, this
Yeah.
trial as this season in life. Sometimes seasons
Mhm.
are stormy, and it's
Yep.
good to have good people around to help carry the load. So I appreciate that. You did a nice
Amen.
job, bro.
Amen, Mark. Thanks so much, and we'll see you guys next week.